Hey folks, and welcome back to the channel. Today we're talking about the stock market and giving some stock market updates as of September 3rd, 2020, what happened today, and my thoughts on the state of the market moving forward. So the market just closed here on Thursday, and we saw a pretty terrible day for the market overall and for tech stocks in particular, with the S&P closing down over 3%. Worst day since June after a couple weeks of steady increases up to all-time high levels. Recent market news has been heavily focused on technology during the pandemic, and most recently talking about Tesla and Apple stock splits. They had a pretty incredible run up through the stock split and after the couple of days after reaching all-time highs, but we have seen those companies in particular taking a tumble since then. So what does this all mean for the market? If you ask 100 experts and analysts, they'll probably give you a dozen different answers on what they think is going to happen. Is this a temporary bump in the road, and are we going back to all-time highs next week? Or is this a wake-up, a shake-up reality check for us to realize what we've seen in the past couple months is absolutely insane and we've kind of fallen back down to earth? We can talk about analysis and predictions all we want, but today I'm really going to focus on what you should worry about based on what your investing goals are. I'm going to break this down into three main categories of investors and reflect on what this means for you. So the first type, the person who's a little bit more financially stable, investing for the long term, either long-term purchases or towards retirement. So we're thinking 20 to 30 plus years down the road. And the general consensus is, right, you're in it for the long-term gains. Compounding interest, compounding gains, 3% year over year for 30 years is quite a lot of money. So for you, individual days or individual years shouldn't really matter. You're only looking at the headlines for the entertainment value to keep an eye on what's going on. But if you're invested in more of a broad index type fund, you're diversified, or even a small recession shouldn't really faze you. You're not going to be needing or using that money for the next decade or two. But if you're investing for the long run and you've picked a couple stocks that you have most of your investments on, yes, you might need to pay a little bit more attention to your investments depending on what stocks, what companies, what funds you have these parked in. You may have to rebalance or adjust given what's going on. Don't want to lose out too much. So the long term, we're probably fine given historical returns. It's not guaranteed, but barring a total economic collapse, we're assuming the goal of the government is to keep the economy moving, keep it growing, and we're assuming that we'll be able to get some gains in the long run. The second type, the day trader, more active, more involved, you're thriving in this period of volatility. This is what we've waited for. The past couple months have been relatively more stable than what we saw in March, April, and May. So this is kind of another shock. Right, we might have gotten complacent in the small gains or the big gains that we've seen, but this is once again a wake-up call that stocks don't always go up. If you've parked a lot of money in your day trades, you're trying to swing on volatility, and you've put a large bet on things continuing to go up, it's a reality check. Sure, tomorrow we might wake up and see things swing back up, a recovery next week, next month. But once again, a reminder, stocks don't always go up. Stocks going up, it's not guaranteed. So you may have to reevaluate your position. But for day traders, high volume traders, we're probably doing the more hourly, minute by minute trades. So this probably will just serve as another reminder once again to keep those other factors in mind. And third type, the casual investor, which most people probably fall into one or three. Casual investor, not for the long run, not day trading. We just have some money in the stock markets. We're thinking maybe we can get a piece of the gains. The important takeaway I think we should come up with here is that past performance doesn't indicate anything in the future. We can use it we can use past analysis and historical events as a starting point or a benchmark to see what has happened. But in terms of large single day drops or stock performance after a split or any other corporate events, things aren't necessarily always going to happen the same way. We saw back in March and April when we're having those circuit breakers, those crazy days. If we have another day like that, it's not guaranteed the day after is going to follow exactly what happened. We had a 3.5% loss today. Tomorrow may not be the same as the last time we had a 3.5-day loss when Tesla and Apple split and their stock just continued to rise 2 days after, and now they've dropped. The next time a Google, Amazon, Microsoft splits, it's not going to rinse and repeat the same formula. We might not see another rise into a drop. Just try not to get held up into what people have seen in the past. The market is constantly changing and no one can really tell you definitively what is going to happen. And another note on that, fear of missing out is very real now. The past couple months, things have been looking good despite the other news. Travel, entertainment has still been hit hard, but the tech stocks have done very well, especially since that initial crash that we had. All-time highs, gaining and gaining and gaining. Will this be a temporary setback, a temporary sell-off correction, or will we see some of those stocks come back down to earth? One thing about valuations is that right now I think it's really hard to correctly value a company given everything that's going on. How do we value companies based on what they're doing now, what we think they're going to be doing? Things are just a little bit crazy right now. Read the analyst reports, look at the company's reports, do some of your own research and some of your own insight, but it's really hard. So when we think about buying stocks at a discount, maybe some tech stock crashed 5% in one day. Think to yourself, is this a discount if it was already overvalued by 20 to 30%? And don't pile that on into the fear of missing out, because for the casual investor, we don't have the luxury. We're not looking at a 30-year timeline. We're not looking at day trading hourly. It's more of a casual thing. We might hold something for a couple weeks, a couple months. So if something crashes and we get into it, if it goes down more, we might be more inclined to just sell it and cut our losses where they are. And once it bounces back in a couple months, we're going to miss out on that. Or if it starts bouncing back, we buy it again, it drops again, we sell it, fear of missing out. Don't want to take too much of a loss, we might miss out again. So really think about what your goals and objectives are for the casual investor, what your time horizon is, how much you're willing to lose, how much you're willing to gain, and say, yep, this is enough, that's great, I'll take it, sell it off, and be happy with the profits that I've made. But in terms of the overall market, I think we will see a resurgence in travel, entertainment, hospitality. We're thinking on a broad scale here. Generally speaking, people are better off than they were before. So what do people do when they have more money, more leisure time, pushing for more vacation, more savings? People have to spend that money somewhere, whether it be on retail or traveling, vacations. More people have that luxury. So when looking out towards the future, the next 10, 20 years, I don't think this industry is going to collapse in the long term. Now for the short term, if the vaccine's not managed correctly, cases have started to slow down, but a lot of that industry is heavily tied directly to what is going on with the pandemic. But on the other hand, the technology industry, I think this is a little bit different than the dot-com bubble and the crash we saw in the early 2000s. These companies are actually offering valuable goods and services that a lot of people rely on now. Things have shifted so much from where we were 5 to 10 years ago. Companies such as Amazon and Microsoft offering actually valuable services. They've become a huge name in the e-commerce industry, Amazon specifically, but they also have other businesses, AWS, Microsoft providing cloud services, which will be a huge part of growth and development in the future. Walmart might be trying to compete on the retail side, but Amazon is still offering Amazon Prime Video, Twitch Prime, Amazon Gaming, a laundry list of other benefits, Amazon Music that comes with that subscription. It's more than just getting free shipping on millions of items, and they've even developed and expanded their own shipping, relying less on FedEx, UPS, USPS for their delivery, streamlining those processes, trying to cut costs there as well. And companies such as Google, Microsoft, Apple, I think their corporate leadership understands and knows that innovation and development is key. With Google working on 1,000 different projects at once across the company, Apple constantly trying to innovate, push out new products. I really think these companies are here to stay, and they are due for even more growth going down the line. Unlike a retail or a travel, companies come and go. Sure, technology companies can, but these are more established companies that are already entrenched in so many aspects of our lives. Unlike something like a Zoom or Slack, Workday, they're only focused on a specific product, a specific item, but something like a Google or Microsoft, they can offer those items. They have retail experiences, they have cloud technology, online technology, IT technology. They're so diversified and they're prepared for the future. Even something like a Tesla, right now, they're light years ahead in terms of their technology and their infrastructure. Other companies may catch up, legacy automakers, more established companies, but for now they have a technology lead. Tesla, I'm not as high on compared to something like a Google or Amazon or Microsoft, but they do have an edge, and they are pushing that edge to develop and expand into trucks, semi-trucks, trying to nail down the autonomous driving. So at the end of the day, we look at today, a single day, things aren't looking so hot probably when you check your account, when you check your retirement, but focus on what your goals are. Set your goals, realize what type of investing you're doing, and don't get too panicked or scared about what's going on the day-to-day. If you're a day trader, yes, this will probably affect you on the day-to-day, but for the long horizons, a lot of people offer up the advice of investing constantly, of investing consistently, enjoying those returns over the long run, which is true. So if you do believe in that, I'm not saying just put your head down, bury your head down in the sand, don't pay attention to anything, just put those $100 a month for the next 20 years. Be smart about your money, right? But those strategies, those goals differ, and your reactions to certain market events will also differ based on what you're invested in and your own goals as well. So those were my thoughts about the market today. I know there are probably going to be a ton of videos out there about what's going on, but if you thought this was helpful, or if you have any other comments, be sure to leave them down below in the comment section. And also hit that like button. Really do appreciate all the support. Subscribe to the channel if you're not subscribed yet, and get notified for all new updates talking about the market, insurance, credit cards, personal finance, all that good stuff. Stay subscribed. That's all I have for today. Thank you so much for watching. Peace out.